Level 1. Analyst. You are 22 years old. You have $91,000 in debt. Your base salary felt significant until you divided it by the hours and saw what your managing director generated in fees on a single afternoon. Your days run 16 hours, sometimes 19. You stop counting after the first month. Check the footnotes in pitch books that will reach rooms you will never enter. You learn to read a 10K in under an hour because the analyst who can't is a liability by month 4. You don't ask why the process is structured the way it is. You learn to work it. Then, one afternoon, buried inside a senior associate's DCF, you find it. A cell reference feeding the wrong input into the discount rate assumption. The kind of error that moves a valuation by $2.3 million in the wrong direction. You stare at it for a long time. You fix it quietly in your own version of the file. You say nothing to anyone. Not because you're protecting the associate, because you already understand without anyone telling you that the system does not reward the person who surfaces the error. It rewards the person who handles it correctly. Honesty and discretion are not the same thing here. They are not worth the same amount. You watch which managing directors command a room and which ones clear it. You learn who gets pulled onto deal teams early and whose name appears on cover sheets. You are processing a $390 million leveraged recap from a spreadsheet on a floor where the lights are still on at 11 p.m. You will never meet the client. You will never see the room. But your numbers are in that room. Your work is in the deck. And one night, looking out at the city from an empty floor, you understand what you are at this level. The foundation. The part nobody sees. The part nobody names. That's not a complaint. It's the geometry. The first rule. The system rewards discretion. Everything else follows. Level 2. Associate. 2 years later, you're in a different room. Not the main room, the side room where associates sit and wait for the meeting to need them. But you're in the building, in the deal, and that is the shift. You're structuring now. Junior pieces, but real structure. You draft terms on a $165 million mezzanine financing. You sit across from a CFO for the first time and explain a covenant breach scenario without flinching. Because you've run that scenario 38 times in the past 10 days. That's your currency at this level. Not intelligence, preparation. Then comes the deal. A leveraged buyout of a regional logistics company in the Midwest. The acquiring fund needs a 19% IRR. To reach it, the post-close model requires significant headcount reductions across 2 distribution facilities. You don't model the human cost. Nobody asks you to. You model EBITDA margins, debt service coverage, working capital efficiency. You present it cleanly. The deal closes in 8 weeks. You collect your bonus. You don't think about Indiana. You rationalize it the way everyone eventually does. You just ran the numbers, someone else made the decision, the numbers were right. You might even be correct. That's the part that makes it easier. You start building your network. A VP who pulls you onto his deals because you don't make mistakes and you don't ask for credit. Level 3. Vice President. You're managing people now. Their output, their errors, their hours. 4 analysts, 2 associates. You stop tracking your own hours. You think in deal flow. Not tasks, not timelines. Deal flow. You close your first transaction independently. A $560 million acquisition financing for a European infrastructure asset moving to a North American private equity buyer. Your MD is on the cover sheet. You are on page 5. But when the numbers get complicated, the covenant structure, the equity cure provisions, the waterfall mechanics, the client looks at you. Not your MD, you. That is the shift at VP. You are no longer being supported. You are the one the room depends on. Then comes the deal you won't name for years. A mid-market industrial acquisition. Post-close, the target company's pension obligations are restructured to make the fund's 21% IRR achievable. You know what that means for the people who spent 25 years at that plant. You don't say it, nobody says it in the meeting. The deal closes in 9 weeks. Your year-end number is $460,000. You wire $38,000 to your parents. You buy a 2-bedroom in a city where a 2-bedroom signals arrival. You tell yourself the pension fund was already underfunded before the deal, that the restructuring was coming regardless. You might even be right. That's what you return to on the nights it needs answering. The third rule. At VP, you stop asking if the deal is good. You ask if it's executable, whether the structure holds, the timeline is achievable, the risk distributable. Whether it should be done is a question that answers itself on the drive home and goes quiet by morning. Level 4. Director. You're sourcing now, not executing mandates handed down from above. Originating your own, clients call you directly, not your MD, you. Private equity shops route deal flow through you because you've never missed a deadline and you've never leaked information. That combination is rarer than it sounds at this altitude. You manage a $1.4 billion book of advisory mandates. Your VP runs the model. Your associate coordinates diligence. You sell the vision, the confidence, the institutional read on where the market is moving. That is the product. You travel constantly. Singapore, Zurich, Abu Dhabi, Dubai. These are not business trips. They are relationship maintenance, and at this level, the relationship is the business. Capital doesn't follow returns alone. It follows trust between the right people, political alignment, regulatory familiarity. The best transaction in the world doesn't execute without that infrastructure underneath it. You start to understand leverage in a form that has nothing to do with balance sheets. Informational leverage, the knowing. You know which companies are running quiet, strategic reviews before any announcement. You know which sovereign fund is building a position before disclosure is required. You don't trade on it, but you know, and the knowing sharpens every room you walk into. Then you lose one, a $2.6 billion advisory mandate. Not because your pitch was weak. A competing director had belonged to the same private club as the chairman for 11 years. A club membership. You don't make excuses. It wasn't unfair, it was the system operating correctly at this level. You joined 2 clubs within the month. You sit on an internal credit committee. $850 million in revolving credit. 6 quarters of balance sheet deterioration. You vote to extend. Not because the credit is clean. Because losing the relationship costs 3 times the exposure over 5 years. It is a political decision. It is presented, recorded, and filed as a financial one. Every significant decision at this level is. The 4th rule. Every major decision at this level is political. It is always presented as financial. Level 5. Managing Director. There are 11 partners in the division. You are one of them now. Your name is not on the door, but in every way that registers inside this institution, it is. You have carried interest in the fund, skin in every significant transaction the firm executes. When the fund performs, you perform. When it doesn't, neither do you. This changes everything about how you think. You stop optimizing for the annual bonus. You optimize for the 5-year fund cycle. You stop thinking in quarters. You start thinking in decades. You lead a $3.8 billion acquisition of a Northern European energy infrastructure company. 4 months of negotiation, 3 regulatory jurisdictions, 2 competing bids, 1 from a sovereign-backed vehicle with a pricing advantage you couldn't match on paper. You win it anyway because your relationship with the seller's board predates the process by 6 years. The closing dinner is in Zurich. The handshake happens in a room that doesn't appear on any floor plan. The structure runs through a Luxembourg holding entity feeding into a Cayman feeder fund. The tax efficiency is substantial. 2 law firms, Dublin and Singapore, have reviewed it from every angle without qualification. You sign without hesitation. The deal adds 160 basis points to the fund's net IRR. Your carried interest on this single transaction will compound to somewhere above $32 million over the fund's life. You stop attending industry events. Not because you're too busy, because the conversations have stopped being useful. The people worth talking to already call you directly. Your social world has narrowed to a small set of individuals who control capital or sit at the exact point where capital meets decisions that move markets. This doesn't feel like loss. It feels like precision. It feels like what you were working toward. Your identity has quietly restructured itself around the machine. You don't notice. Nobody does. Not at first. Level 6. Senior Partner. 2 calls this morning. They want your firm to anchor the deal flow. You are one of 2 firms they will give that mandate to. The second call is from a finance ministry, not a banker representing the ministry, the minister. You take both calls from the same chair, 41st floor, corner office. No trading screens, no Bloomberg terminal. Just glass and silence and a phone that connects you to people who move entire asset classes. You are not in the market anymore. The market is in you. Your positioning, your deployment decisions, your read on a sector, these move price discovery. When you pull back from a deal class, analysts write about it for weeks without knowing your name was involved. You sit on 3 corporate boards. You advise a multilateral development bank's infrastructure program across Southeast Asia. You brief a Government twice a year on capital market conditions. You do not lobby, you advise. The distinction is legally real. The influence is identical. The consequences of what gets decided at this level are too diffuse to feel. Distributed across too many institutions, too many quarters, too many balance sheets you will never read. You don't feel the layoffs downstream. You don't feel the communities reshaped by the asset sales your funds required to hit their return targets. What registers is the fund return. You optimize the fund return. That is what 20 years inside this machine produced. That is the system operating exactly as designed. The fifth rule: there is no outside perspective anymore. You are the perspective. Level 7. Global head. You run the division now, not a desk, not a product group. The division. 12 offices, 400 people, approximately $2.1 billion in annual fee revenue that moves through structures your analysts built, your MDs closed, and your name sits above on an organizational chart that no one outside the firm will ever see. The calls are from regulators now, alongside the clients. You testify before a parliamentary committee on capital market stability. 6 lawyers prepare the remarks. You deliver them without notes. Every word is reviewed not for accuracy, but for what it commits the institution to going forward. That is the new constraint at this level. Not what the deal is worth, what the statement costs. You kill a transaction. A $1.9 billion cross-border acquisition, 18 months in origination, 3 managing directors' client relationships staked on it. The financial case is clean. The regulatory exposure in the target's operating jurisdiction creates a disclosure obligation that runs forward for 5 years. You end it in one meeting. The MDs don't argue. They understand that protecting the franchise is the transaction. The compensation is now base plus deferred equity vesting over 4 years. No carry. You are no longer a participant in the fund. You are the institution's public face on its most significant relationships. The bank owns a structured piece of every decision you make, recorded in an agreement you signed without reading closely, because by the time you reach this level, the terms were already understood. You are the machine now, not a metaphor, the arrangement. Level 8, full circle. Somewhere in a glass tower in a city that never stops moving, a 22-year-old opens a terminal for the first time. His badge says Analyst First Year. It has always said that. It always will. He thinks this is about the salary. He thinks the system rewards what you put in. The hours, the precision, the willingness to stay when everyone else has gone. He thinks if he runs the numbers cleanly enough, long enough, the numbers will eventually run in his direction. He doesn't know yet what the system actually rewards. He doesn't know about discretion or the $2.6 billion mandate that turned on a club membership or the pension obligations restructured somewhere in the Midwest so a model could clear 21%. He doesn't know that the social world he has now, wide, loud, full of people with no proximity to capital, will narrow over 20 years until it fits inside a corner office on the 41st floor. He doesn't know that the questions that follow him home will eventually go quiet by morning and stop coming back. But he will find out, the way everyone finds out. Not through a warning, through participation, through the first error he fixes silently and tells no one about, through the first deal that closes somewhere he'll stop thinking about. Through the first room he walks into not as the support, but as the person the client turns toward when the numbers get complicated. The terminal blinks, the market opens, the machine takes another step forward.